Thanks, Brian, very much. And it's an honor and a privilege to be with the PNAA, especially during these challenging and difficult times. So I've got about 10 minutes here, and I've got about twice as many slides. So what I will do is move relatively quickly through them. Very quickly, who we are, just so you have a background about us and where we're coming from. We'll talk about our latest survey. We do a number of surveys throughout the year. We'll give you the output from our latest surveys, which are actually pretty revealing. And then we'll talk about what we forecast for the year ahead. Like everyone else that's forecasting at this conference right now, a lot depends on the pandemic. We're doing the best we can. We're all doing the best we can, but we will stick our necks out there and make a forecast. Caveat that if things change dramatically in the pandemic that none of us are expecting, this forecast is going to be off by a little bit. Real quick, who we are. We're investment bankers. We're a registered securities broker-dealer with the SEC and FINRA. We exclusively work in the middle market of aerospace and defense, and we're exclusively sell-side M&A bankers. So companies hire us to see them sold, mostly to private equity firms or strategic buyers, and we were founded 20 years ago. It'll be 20 years ago in March. Very quickly, my background, I'm going to skip this. It'll be in the presentation. I'm not going to waste time with this, but I've been doing this my entire life. I have an MBA in finance. I've been a commercial pilot, been flying airplanes forever, and I love the smell of kerosene. I have two colleagues that work with me, and both esteemed and established gentlemen, a couple years older than I am, and you can read their bios on the background. Kevin Gould and Bruce Andrews. Wonderful gentlemen with a wealth of knowledge and a sampling of some deals that we've done across the sector. And again, that'll be posted on the video that you'll be able to access. Very quick client demographics, just so you know who we are. I'm not trying to give you a sales pitch. This is really meant to be some data that's helpful to you. But these are our clients, mostly domestic, some outside the US. And there's the mix, 36% classified as commercial aviation. And obviously a lot of you out there right now are very few of us are pure commercial aviation. We may have a smattering of business aviation. We may have a smattering of defense in our business. Very few are pure play commercial aviation, but about 36% of our clientele is, quote, commercial aviation. And a mix of manufacturing, distribution, and service providers, and that's who we are. All right, latest survey, the good stuff, the stuff that I think you'll find interesting. We did a survey between January 6th and January 14th, so it's almost a month old now. And we asked strategic and private equity participants about multiples in the year past and their view for multiples in the year ahead. We can get into some fancy math here, and I don't want to bog down in a short presentation. But the key here for a broker, which is what we are, is we like activity. We actually are relatively agnostic to whether prices are rising or falling within reason. Obviously, when we're selling a company for a client, we want them to get the highest price. But in terms of our business and deal flow, we want deal flow. And if willing buyers are doing deals with willing sellers, there's deal flow, happy deal flow. Sellers are happy. But when there becomes too large of a divergence of expectations on value, multiple expectation, then the market starts to seize. And this actually is just common sense. When prices are deeply discounted and things are distraught, there's a drying up of activity. So you can look at these data points later, but optimistically, we are seeing next year, the year we're in now, that the compression between buyers and sellers, their view of value, is going to come back more towards a matching point. The spread, as we call it, grew 54% last year. That explains why the market seized, and there was very little M&A activity, especially deep in the supply chain where we live. If you look at the year ahead, you've got a 16% improvement in the spread. That's good. That's a great indicator for more M&A activity in the supply chain the year ahead. And obviously, I don't have time to go into this, but there's a lot more data we can share. So we see two separate markets going forward. Yes, we see market pricing compression, which is good for the overall market, but we really see that taking place in the aftermarket. If you talk to the clients we have and the buyers we're talking to, there is already beginning to be active activity in the M&A market. It takes 6 months or 9 months to get a deal done. We expect the second half of this year to be there will be a large number of announcements of deals closing, we believe, in the latter half of this year. Buyers are beginning to price in growth. They're willing to say to sellers, we believe you will do better next year. Values are recovering and sellers are becoming motivated because prices are rising. However, in the OEM supply chain, we are seeing and we expect to see limited M&A activity. I'll talk about this more in a few slides. Values are depressed. We know that. Distressed buyers are looking. And those that are not in the M&A world may not know this, but there are a lot of buyers out there, especially in the financial side of the market, looking to buy in the commercial aviation supply chain. However, there are not many motivated sellers because values are depressed, because there has been ample liquidity, PPP 1 and 2, and the banks are not foreclosing. And again, this slide warrants a 3-hour conversation. Quick example of a deal we did last year, and I've got 2 minutes left and 10 slides to go. So real quick, we were hired by a client. We were selling a company with a lot of intellectual property in the supply chain. Parent company was restructuring. The business was losing money. The EBITDA multiple was infinite because of the math. And the buyer was willing to buy growth and pay for growth. Unique story. Glad to talk about it with you guys at some point. So valuations. What are we seeing on the valuation side? And what we are seeing on the valuation side in the aftermarket is that the market has fully recovered. This is public stocks, a couple of examples, HEICO and TransDigm. The red line is 0. The overall S&P market is up 20%, but the stock prices for TransDigm and HEICO are back where they were pre-pandemic levels. That is a great indicator for what will be happening in the supply chain in terms of values. Next slide shows us and this is some fancy multiple math that I'm running out of time on, but you can see some really weird things in multiples. And here's an example, a very quick example of a company that actually had its earnings go up and its multiple going down. And if anybody wants to talk to me about this later on, I can explain why, but multiples can look really weird in a rapidly rising market. This is multiple depression when values are rising. And I can talk about the math if you guys would like me to. New production, if you look at an example of Triumph Group and Spirit, they have not recovered. They're down 50% still pre-pandemic, and the stock market, S&P 500, SPY ETF, is up 20%. That means these two stocks are off 70% from the market. There's no recovery there taking place in terms of equity view of value. Here's an example of multiples in a down market. Everything is negative for this example, and yet multiples are up. Again, weird multiple math. I can explain that to people afterwards. All right, I have 1 minute, and I'll give you our forecast for the year ahead. Commercial aviation aftermarket will start to recover. These are basic assumptions leading to the next slide about M&A. Airport services, line maintenance, component maintenance, spares, and engine maintenance will all recover first. Commercial aviation OEM production will not see a recovery this year. Narrow bodies will not see a recovery in 21. Wide bodies are going to be after the narrow bodies. Liquidity from the federal government here in the United States is going to wane in the second half of this year. Therefore, bankruptcies and forced sales will accelerate in the second half of this year. Here's our takeaway in my last 30 seconds. M&A forecast for 2021. The aftermarket M&A activity will see an increase this year. People have already cut costs. As their revenues rise, cash flows will rapidly rise on those leveraged operational benefits. Buyers will price in growth into their DCF models. Offers will approach pre-pandemic levels. Owners that wanted to exit last year will be able to exit later this year. Multiples will look weird because of that slide I showed you earlier, which if anybody wants, I can give them a lesson on multiples math. And OEM suppliers are going to have to wait if they can. Distressed buyers are already looking in that market, but the sellers are not selling. The pricing isn't there. Owners do not want to exit at these kind of levels. Suppliers that run out of cash will be in trouble. And if government support, there's no PPP3 maybe, then some of these suppliers will fail. There will be forced exits, and some of those distressed buyers will get what they want. However, some of the multiples will look odd. You'll see really positive multiples for really bad deals because of multiples math. That's my email address. My alarm's going off. If anybody would like further conversation about any of this, that's the email address. I'd be glad to have a conversation, chat with you, answer your questions.